Hello and welcome to Quilter Cheviott's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviott. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Simon Doherty, Head of Managed Portfolio Services based out of our London office. And this week, I'm delighted to be joined by regular contributor and Head of Fixed Interest Research, Richard Carter, alongside Samir Shah, one of our investment analysts on the award-winning Quilter Cheviott Fund Research team. Good morning to you both. Richard, I'll turn to you first, if I may, and it's clearly a topic with a lot of mileage in it yet, but last week was obviously a big one for political news flow on the other side of the pond. We had a significant decision from the US Supreme Court, a Super Tuesday for a former president, and a rather angry State of the Union address from the current one. Can you talk us through what's been going on?
Yeah, Simon, you're absolutely right. It's been a busy old week on the US political front. But I think it leaves us kind of where we were expecting to be, which is we're facing the depressing prospect of a rematch of Biden versus Trump when we get to November. I think, lots of talk about Biden's ability to sustain, another campaign and another 4 years as president, and he kind of did his best to sort of confound that with a very energetic kind of, as you say, State of the Union speech. So he looks like he's on course to carry on and go for the election in November. And obviously, Nikki Haley's now pulled out of the Republican race, so that leaves the field clear for Trump. And whatever legal issues are being thrown at him, including with the Supreme Court, he just seems to be overcoming them, and his support in the polls is strong enough to suggest that it will be, as I say, Biden versus Trump when we get to November.
Great stuff. Thanks. Yeah, as you say, I think an increasingly, albeit not completely clear path to facing Joe Biden at the ballot box. So let's see what comes next. If we move away from politics, we also heard from Fed Chairman Jerome Powell with his testimony to Congress appearing to confirm that rate cuts are on the way in the months to come. How did you interpret his comments?
Yeah, again, I think it's kind of within the sort of bounds of the current market narrative. It's very much it's too early for central banks like the Fed and the Bank of England to be cutting rates. But as long as the sort of data is well behaved, inflation keeps coming down, then they should be able to do so from the summer onwards. I mean, I guess cast your mind back, earlier this year, we were expecting a rate cut as early as March, or certainly the market was, and that hasn't happened because the data's just been too resilient. But we do think probably from the summer onwards they should be in a position to do that, and that's really what Powell was saying, is that they just need a little bit more confidence, see a little bit more data. But that's basically, as I say, cutting rates from the middle of this year, hopefully.
Yeah, and obviously we also saw the ECB leave rates unchanged last week, but interestingly also reduce inflation forecasts at the same time. So quite a lot of focus on central bank narrative, obviously in recent months. Does it suggest, from what they were saying as well, that cuts are to come early in the early summer in Europe too?
Yeah, I think we can sort of bracket the Bank of England with this. It's interesting. I think you've got three major central banks. Bank of Japan's different. Bank of Japan's probably heading in the opposite direction, maybe with rate rise. But I think you can bracket the three main central banks, certainly as far as we're concerned. But Fed, Bank of England, ECB, they are in a similar place. Like you say, ECB revised down their forecast. And Christine Lagarde was pretty clear. She was saying by June we'll have a lot more data, a lot more information, and we should hopefully be in a position to start easing policy, which would be great. And I think we'll probably hear, similar story from the Bank of England at their next meeting, next week. It's just they just need a bit more comfort on the inflation front before they start doing anything in terms of bringing rates down. But that seems to be the direction of travel. And that's good. That's good for bonds. That's good, I think, for equities. I mean, the risk would be that inflation's stickier than expected. Those bond yields go back up again, and stock markets come under pressure. But that doesn't seem to be the case at the moment. And we actually had sort of non-farm payrolls in the States last week, and then okay, the headline number was reasonably strong, but unemployment picked up, wages slowing. So it is all pointing towards, hold off for now, but once we get to June onwards, we should be in a position to cut rates.
Excellent, thanks. And if we move away from central bank policy, obviously the big news event in the UK last week was the spring budget. Obviously a bit of time to look at the announcements there, and perhaps not quite the tax bonfire event that Messrs Sunak and Hunt had hoped for in this election year at this point, given their diminishing fiscal headroom in recent months. What were your key takeaways from the budget, and how did bond markets react to the news?
Bond markets gave it a big shrug. I would say. I think we have a big focus on budgets in the UK, but most of the time, bond markets are focused on other issues, particularly what we've just been talking about, central banks. I think my biggest takeaway is that we're probably not having an election in May, because crikey, if that was the launch of the campaign for an election a few weeks away, it was a pretty damp squib on that front. So I think, just like the US, we've got to wait until November for the big political event. I mean, I think to be quite honest with you, with bond markets, they sometimes worry about public debt and public finances, but most of the time it's kind of a secondary issue to inflation and unemployment and all the rest of it. And I think clearly, Jeremy Hunt, UK government, have learned their lesson from what happened with Liz Truss and the mini budget. You can't play fast and loose with the public finances when we're so heavily indebted because of COVID and other things. And I think that's why, even though there's a temptation to cut taxes more aggressively, they realise they just don't have the leeway to do it. So, bond markets are reassured by that and can go back to worrying about the stuff they're normally worrying about.
Great, thanks. Richard, now I'd like to take this opportunity to bring in Samir alongside as well, given that one of the bigger announcements at last week's budget was the introduction of the UK ISA. So, Samir, as our resident UK equity fund expert, can you tell us what we know at this stage about the proposals?
Hi, Simon, and thanks for having me here today. So overall, I would say that this is a step, albeit a small one, in the right direction towards encouraging investment into UK equities. So during the budget, it was announced that this new ISA would have its own £5,000 allowance in addition to the existing ISA allowances dedicated towards UK equities. Now, as you quite rightly said, the consultation ends in June. And so realistically, any conclusion and implementation will be in the next tax year at the earliest. Now, the theory behind the proposal is that the UK equity market remains unloved and continues to suffer from capital outflows and a reduction in the number of listed companies. To reverse this trend, we are being offered a tax-efficient channel to deploy capital. So I think the consultation will help define two key aspects of the proposal. Firstly, what is the definition of a British company? Now, there are arguments to say it should be based on listing. Others say it should be based on where the assets reside, or indeed where revenue is generated. The current guidance is that companies with at least 75% of assets in the UK would be eligible. The other aspect that needs confirming is how the fund would be administered. It would need to be specifically identified when making investments, and it could be quite complicated for platforms and advisors to maintain and ensure compliance with the restrictions. Now, as you know, where there is complication, there is normally an additional layer of costs, and that might prove to be a material deterrent. Lastly, I'd like to mention that in the tax year 2021, only 15% of ISA subscriptions use the full allowance. And so at best, this new ISA is likely to see inflows at the margin only. Having said that, overall, look, I'd say it's a good initiative, but as always, the devil is in the detail. And so we need to wait and see what the final proposals will be.
Thanks, Samir. Really comprehensive there. And if I can just pick up on one of the points you raised, that topic of the unloved nature of the UK stock market has been one that I've spoken about, with a lot of advisors and clients for quite a long time now. So too, the shrinking number of listed companies in the UK and indeed globally as well. You did touch upon it, but do you really think this proposal will help reverse those trends? And will we see a better outcome in terms of capital flow to the UK stock market?
Yes, that's a great question. And to be honest, this initiative on its own is unlikely to have a material impact. Having said that, there are two other areas of change that I think will have much more of a material impact potentially. Firstly, we could abolish stamp duty charges on buying stocks. Currently, the charge is 50 basis points on each transaction over £10,000. I see this charge as being out of date and extremely anti-competitive for UK equities. In a world where transaction costs in many developed equity markets are less than 20 bips, this cost seems excessive. And on the issue of the falling number of listed companies, well, I don't think the new ISA will reverse this trend. But having said that, to be clear, in my mind, the issue is not the reduced number of companies per se. Rather, it is the total market capitalization relative to the UK economy that is the issue. The entire UK market cap is less than the top 5 companies individually across the globe. So for us to see an increase in the number of listed companies, personally, I think we need to see a reduction in the administrative burden placed on companies to list in the UK. That's a reduction of costs, of being more flexible with admission rules, such as dual share classes and lower free float regulation. It's here that I think changes would have a more material impact.
No, thanks. Some really interesting points there. And I think it leads us on quite nicely to my final question, really, for you, Samir. Despite some of those challenges, limitations, some of that regulation in place at this point in time, you're still quite positive on the opportunity in UK smaller companies at the moment. And, again, that's despite a fairly lackluster economic outlook as well. If you think about, the recent hit to sentiment with the technical recession the UK economy went into at the end of last year. Why are you positive on the outlook for small cap UK stocks?
Yeah, with the UK being so out of favor, quite simply, it's the relative valuation that looks attractive across the board, but in particular within the UK small cap sector, which really stands out. Its 10-year average 12-month forward PE rating has historically been around 15 times, and it currently trades at 11 times. Now, whenever we have been at these depressed multiples, the following 2 years have led to above average gains. Now, we think that in the absence of a hard UK recession, the sector is primed to re-rate. Now, we can see evidence of this by the number of private equity takeovers within the space, reflecting just how cheap the sector is at the moment.
Fantastic. Thanks, Samir. And thank you to you and Richard for those great insights today, and indeed to all of you for listening. And just as a reminder, if you enjoyed our discussion on the podcast today, we would love to hear from you. So please review the show now wherever you are listening. And we'd also be grateful if you could share it via social media, tagging us at QuiltAchieveIt. And to make sure you don't miss a future episode, tap the subscribe button as well. We'll be back next week. In the meantime, head over to our website, www.quiltachieveit.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And to celebrate last Friday being International Women's Day, on Tuesday, the 26th of March at 11 a.m., we will be joined by ex-Royal Air Force pilot and best-selling author Mandy Hickson for an insightful discussion on the key themes that intertwine aviation and investment. Navigating turbulence is a shared challenge, albeit in slightly different ways, for both pilots and investment managers. And together, we'll explore the importance of having the right experts by your side to overcome these complex scenarios. If you can, I firmly encourage you to sign up by visiting the events page on our website. So that's it for today. Thanks again, and see you next time.